You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. It is a dangerous world out there. Volatility is on the rise, and your clients' portfolios are under assault from a growing number of threats. Simple diversification is no longer enough to shield the assets under your protection. Registered investment advisors, financial planners, and asset managers need a new weapon in their war on risk. Welcome to the Advisor's Option, the program designed to arm busy advisors with the information necessary to properly manage risk in this volatile environment. From options education, trading strategies and tips, to industry news and interviews, you'll find it all on the Advisor's Option. The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by SWAN Global Investments. Since 1997, SWAN has been the leader in hedged equity and option income strategies with GIPS verified results. SWAN provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, SWAN defined risk mutual funds, or our proprietary option overlay strategies, please contact Randy Swan at swanglobalinvestments.com. Think outside the style box. Think SWAN when deciding on risk management solutions to market risk. The Advisor's Option is also brought to you by Option Research and Technology Services. ORATS is your source for options backtesting. It's where you turn your ideas into results. Founded on the floor of the SIBO over 2 decades ago, ORATS is a full-service option research firm focused on helping you develop options strategies in line with your investment objectives. With a state-of-the-art backtesting platform, scanning, and implementation tools, ORATS offers end-to-end option strategy development, making the whole options trading process easier. For information about backtesting, scanning options data, including dividends and earnings, visit orats.com or email Matt Amberson at matt@orats.com. And now, it's time to learn how to implement options in your practice. It's time for the Advisor's Option.
Welcome back to the Advisor's Option, the program here on the old Options Insider Radio Network for you, the busy financial advisor or asset manager who's wondering how can, or maybe how should, I be using these options things in my clients' portfolios. Well, don't worry. We've got you covered. My name is Mark Longo from, as I mentioned, the old Options Insider Radio Network, as well as, of course, from the new fresh coat of paint over there on theoptionsinsider.com. Check it out if you haven't done so in a while. A lot of great stuff. Of course, all of our shows front and center. A lot of great content as well, including those cool earnings move results reports. I know a lot of you like those. Click on those options news and articles tab on the top right corner of the homepage to begin your odyssey down that road. Now, however you listen, however you engage with our content, make sure send in those questions, those comments. We do love to hear from you guys. And we're a little bit scattered here on the show today in terms of moving pieces, moving parts ahead of the big hurricane. I shouldn't say big yet, but the storm that's approaching here on the eastern shores here. So we had to adjust our recording schedule a little bit. If I sound a little bit different, listeners, it's because I'm coming to you from the path of said hurricane down here in the southern studio of Florida. Don't worry, I'll be getting out before all this stuff pops off down here. But you know who's already gone through it? It's old hat to him. Let's dial the clock all the way out there to the Atlantic, to a nice little sunny isle known as Puerto Rico, where we are joined once again by the Director of Risk himself, Mr. Chris Hausman from SWAN Global Investments. Mr. Hausman, a.k.a. the Director of Risk, how go things in your recent hurricane foray, sir?
Well, things are good. We dodged a bullet, and like you said, it's heading your way right now. But other than that, guess what? It's sunny again.
Yeah, it's always sunny over there. Thanks for handing it off to us now, and we can get a much stronger one. So thanks for that, by the way. But other than that, yeah, interesting stuff abound. That's one of the reasons why we're not joined by our old friend Mr. Cott today. He's getting the heck out of Dodge. He's scampering out of Florida while the getting is good, so he won't be able to join us on the program today. But we do have from someone who's up there in the relatively hurricane-safe New Hampshire, where we are joined once again by Mr. Matt Amberson, the founder and principal over there at ORATS, a.k.a. Options Research and Technology Services, a.k.a. the guys who put together all those cool earnings move results reports that you guys devour on such a regular basis. Mr. Matt, welcome back to the program. Are you too evacuating, even though you really have no reason to?
No, this is a great time for us surfers in the Northeast. The forecasts were correct, and the waves from Dorian made it all the way up here, so we had some fun this last week.
That's true. I grew up in southern New England, so I do recall those days of right before the storm hits, heading down to the beach and just body surfing and all the other fun stuff that you could do. Lots of fun stuff cooking, including a lot of fun stuff scheduled for the show, so let's get to it with a little bit of the old buzz. All right, everybody, welcome to The Buzz. This is indeed the portion of the show where we talk about what the heck is lighting up our tapes, what is going on out here in the markets as well. We are kind of in a bit of a weird environment from a volatility and market perspective. We're going to get a little bit more into that in our Options 101 segment a little bit when it comes to specifics about volatility. But before we do that, let's kind of go around the horn and kind of catch up with everybody on their thoughts on where we are. We're recording this, listeners, in a kind of a strange time. We're at the tail end of a week that's been topsy-turvy, mostly to the upside lately, as a result of all the trade war shenanigans going off. Volatility for this seasonally adjusted time of the year, usually a pretty quiet period. The dog days of summer heading into a holiday weekend, usually not a heck of a lot going on. Also, usually not a heck of a lot of volatility on the tape, and yet we have seen a remarkable amount of both of late, which is kind of interesting, a little bit bizarre. Some of that vol coming off today, but you never know how long that's going to last. So let's start over there in the office of the Director of Risk. Catch us up, sir, when you're not dodging hurricanes. What's been going across your tape? What's it been like over there at SWAN in the last month and change as you've been watching this trade war madness unfold in the marketplace?
Well, the short-term volatility is definitely back. I remember last time we were talking that the seasonality was about to change on us. So I agree with you. Usually August kind of has a very lull until we hit September, and then it starts to pick up. So maybe a little bit early this year, but we know why. I mean, the markets are very tweet dependent right now, and this trade war and volleying back and forth between, the China and the U.S. is really keeping the VIX elevated. You've seen a floor of about 16. It's had a couple of touches in the 15 handle, but the range right now, for the most part, you can say 15, 20. A couple of stabs over 20. So I think for the prop traders, the day traders, the guys on the floor, this is probably the type of perfect environment that they want. And then for us on the other side, if you have a hedged equity product, it doesn't really, it doesn't do too much to our positions because we're already hedged, we're already in at good levels, and it's just a matter of just kind of sitting back and watching the flow and trying to, maneuver the income, the short volatility type of strategies. But for the most part, we're still range bound. We're range bound in the SPX and the overall market, and the VIX has given us a pretty good range this month so far.
Yeah, pretty good across the board. They're pretty good range, pretty good volatility, pretty good everything else for a time of year that is usually pretty quiet. Mr. Matt, same question for you. This actually time of year is not quiet times for you guys over there at ORATS because we are still on the tail end here of earnings season. I know you guys added an interesting new wrinkle to your analysis this season. You added an earnings season report, which is kind of interesting, breaking down how everything is unfolding from week to week. So catch us up. How has this season, this cycle, how has it unfolded? Any interesting surprises or nuggets therein for you, sir?
Yeah, it's. I'll get to that in just 1 second. But the overall volatility, we have another new product for you, Mark. We average.
I can't keep up with all the products, sir. You guys are just hot and heavy over there these days.
So we're coming out with these component ratings for the top 30 ETFs and indexes, and so we weight them and compare all the underlying components to the ETF. But we also, one of my favorite ones, just to measure all of our 4,500 symbols. And for the first time in a long time, and I put a blog out, we're seeing the implied volatility to historical volatility ratio under 1. So typically, implied volatility trades as a premium to historical volatility, but now it's about 97%. Usually it's about maybe 17% over, and now it's 3% under. Apple, for example, is 17% under its historical volatility. So things are moving around, but the implied hasn't really come up to it yet. We've talked about rules of thumb before that where the market makers don't get volatility low enough in the quiet times, and so selling volatility still works, but in the high times, like it is now, they don't get it high enough. So that's what I'm seeing overall, and that's spilling over. Yeah, as you say, we have a really neat season report. So we break down the earnings season into 6 weeks. So typically starts midway through the month of the quarter. So what is that? January, April, and then we just had July, and then we'll get it again in October. So, but this one has been the craziest by far. Earnings season. We got all this trade war stuff that exacerbated all of the earnings moves. We've really seen like some outstanding moves from a mean perspective, and what I mean by that is, for example, this earnings season is 96% over. So only 4% of firms in the top firms that we're tracking have yet to report. Actual moves divided by their implied moves. We do some calisthenics to get what the market is implying using straddles and taking out what we think is going to be left over. So that ratio is 14% over. So that's the highest that we've ever seen in any season. 4 seasons a year, going back 12 seasons. So that has been big. And then, the funny thing was that last week was the worst week. Like it's only, they lost, owners of straddles lost about 18% because of the knee-jerk reaction. They really overvalued the earnings. So this earnings has been quite tumultuous in many different ways. And then we do then our huge back tests. So we've done hundreds of thousands of back tests, trying to see, okay, if you would have purchased straddles before each earnings season and sold them after the day after earnings, so bought them the day before, sold them the day after, how has that been, and who wins? So the win percentage, as we've reported quite a bit, is about a little less than 40% for owning a straddle. So it's pretty tough. However, if you look at just the absolute returns, the long straddle usually wins over, we go back to 2007. So that, the average is negative because of commissions and such and traveling the bid-ask spread. We have some rules for commission and slippage. So, but if you look at just a comparison, basically just mid-market to mid-market, the long straddle owners actually beat in absolute terms although they don't win as much. So that's a mouthful, a lot going on, but that's what we're looking at over here at ORATS.
I encourage all of our listeners, if they are even remotely intrigued by that, and I know a lot of you are, then head on over to orats.com, orats.com, or indeed to theoptionsinsider.com. Click on the earnings move results reports there. I like the season report. I think that's an interesting new wrinkle to the analysis. And I like what you're talking about there, Matt, with the volatility. You know, there's a couple of indicators that I always think are pretty useful, pretty spot on. One is when the volatility, aka VVIX, gets down into that 70 handle range, and you typically know that something's going to happen at some time in the near future. It's not going to stay there for very long. And the other one is kind of the one you just mentioned, that risk premium, that implied to the realized, aka the historical. When realized starts creeping up on the implied, then you know we're in for some interesting times. Speaking of interesting times and volatility, it's a perfect segue to dive right on into our Options 101. All right, everybody, welcome back to our Options 101 segment. This is indeed the portion of the show where we break down a basic options concept or tip or strategy or technique and explain how you can utilize it in your clients' portfolios. Today, we're talking maybe a little bit beyond 101, but maybe not quite 102, somewhere maybe 101 and a half range, because we're talking about volatility. It's a very, very popular topic, very important topic. Usually a very, very seasonally relevant topic this time of year, because coming into the final portion of the year, certainly coming out of the dog days of summer, usually we see volatility seasonally quiet right now, and then start to reemerge, to reassert itself into that September, into October timeframe. The oft-used cliche of Rocktober is thrown around every now and then. So let's do a basic overview here of what we're talking about when we're talking about volatility and trading it and how you can maybe utilize it in your clients' portfolios. Of course, we're in a weird time right now from a volatility perspective because we're not seeing that seasonally quiet bit of volatility. We're seeing a lot more volatility in the marketplace than we're used to this time of year, and that throws a little bit of a wrench into the calculations here, because planning for the return of volatility when it's already still here is a bit of an interesting thing. But let's talk about what we mean when we're talking about trading volatility. Let's start with the basics. I guess you can call it the pure, aka maybe just the straight volatility, no ice, no chaser, just pure volatility in that glass. That's where you're looking at, typically, you're looking at SPY or SPX, or maybe in the E-minis if you go the futures options route. The straddles out there, those are kind of the most basic volatility play you can have. Loading up on an at-the-money straddle and pick your month, pick your product. That's going to give you obviously a lot of direct volatility exposure. Also a lot of other things, time decay, everything else that you have to deal with those types of positions. Another way you can utilize those is, of course, to go into maybe a preferred method rather than just loading up on long straddles, maybe some more risk-mitigated types of approaches like verticals, which are, of course, buying one contract in a certain expiration cycle and then selling a farther out-of-the-money contract in that same expiration cycle. So maybe you do DC verticals in a SPY or an SPX, or maybe some of the spreads with wings. You talked about many times here on the show, your iron flies, your iron condors, these just your typical butterfly, maybe even of your typical risk-mitigated types of spreads where you know exactly what your outlay is, you know exactly where your pain points are, and you could trade from there. So if you want to get your volatility straight from the horse's mouth, straight from the fire hose, if you will, then going that route, trading in the actual underlyings themselves, your SPXs, your SPYs, is a way to go if you're a little bit more savvy and understand what you're doing. Now, if you're trading, obviously, those long straddles, that's probably one of the more difficult ways to go because it requires a lot of constant dynamic hedging. So maybe not the best use case for busy advisors who have to deal with their clients on a regular basis, but for some savvy few out there, that may be a way to go. Then we get into the volatility regime, the volatility complex, aka VIX. When you're talking S&P or particularly SPX volatility, you're talking VIX. That's the big boy out there. That's the 800-pound gorilla. That's the one everyone quotes, usually mistakenly. That's the one everyone talks about. That's the one you see all the time on places like CNBC and others. The fear gauge. That's what everyone's talking about. That, of course, is, well, it used to be the straight-up at-the-money implied volatility of the S&P 500, aka the SPX. They've since played with that calculation a little bit. They've added in the out-of-the-money calls and puts. They've added in some weeklies. They've nuanced and massaged that calculation quite a bit hence maybe some of the issues people have with that contract right now. But still, that is the big dog in the volatility space. When you're looking at volatility in the VIX, you're talking a couple of different products. The thing that's always quoted out there, of course, is the VIX cash, which is really just an index that's calculated and disseminated by the SIBO, but it's not tradable. You can't go out there and buy the VIX cash. Some products have tried to replicate that without too much success. If you want to trade the actual underlying of, you have to go to the futures. I know that's a scary thing for a lot of people out there, but you have to look at the futures. That's where the actual pricing of the VIX, where the rubber meets the road. And then, of course, the options. The options are indeed on the futures, not the cash. So when your clients ask you, hey, what are these pricing off of, you can have a fun time explaining futures to them. But that's where a lot of the rubber meets the road. Before we keep rolling at some other products that are out there, maybe let's go back around the horn. Let's start with the director of risk. Chris, you guys are dealing with advisors and a lot of outreach, not just on this show, but on your 10th box and a lot of your summits and everything else like that. I know the topic of volatility comes up quite a bit. When you're talking to an advisor about what they should know, what they should prep, maybe for this time of year, traditionally when volatility may return to the marketplace, or maybe in this case, stay elevated for the foreseeable future, what do you counsel them? What should they be aware of? How should they be approaching it? And maybe what types of approaches should they have for actually trading it for their clients?
Well, I think the important thing is to pick your points. Be patient when you're in this type of marketplace. You go back to a very low volatility period where that actually is a good time to sell premium because, like Matt said it, vol gets it wrong on the low end and it gets it wrong on the high end. And right now, where it's getting it wrong on the high end, and he presented some fantastic data on all these single stocks on where the implied just isn't covering the risk, with the movement out there. And that can be the same. You can apply that to the index products as well. And what I wanted to also add is it's not just about the SPX or the VIX. This is actually a really good time where small cap, RUT, IWM, then you have emerging markets, EM, and the big index or foreign developed. All four of these larger indices are trading a little different. And so there is opportunity between these different products, to scalp volatility, if you will. And also with the VIX as well, don't forget, there are VIX calculations on all kinds of other products. You've got on the NASDAQ, you've got on the RUT, emerging markets, gold, foreign developed. So, I think if you're an advisor, you need to be patient, pick your points, open up that toolbox and not just look at the SPX, SPY, which, obviously is the biggest one, but there are other areas where there's opportunity.
Matt, same question for you. People that come into ORATs now looking for maybe volatility-oriented back tests, looking for maybe some advice on strategies and approaches. This is obviously the time of year people start thinking about these things traditionally. So what do you typically counsel them? What are some approaches? What are some products? What are some methodologies they should be considering when thinking about dipping their toes into these volatility waters, sir?
So we use our back tester, and one of the things that we can do in our back tester is look at environments, like look at volatility environments. So is the volatility high? Is the volatility low? I like to look at what's called contango of just regular SPY. So are the lower months below, at, or higher than the short-term, longer-dated months? That is one of my favorite indicators. So what we'll do is we will sculpt strategies based on levels of contango, levels of IV rank or IV percentile, and go into how they behave, how they perform, what performs the best. We talk about the rules of thumb, but there's also quite a bit of what we found is just you want to stay out when that contango starts getting crazy like it is now. We've been basically out on a lot of clients, since the end of July when contango started falling out of bed. So that's a really good time, I think, to if you're going to be selling a little bit of vol to pay for out of the money puts is what I like to do. Is at these times when it gets a little bit wonky out there, you want to pull in, and take off, I think, some of the income producing strategies and, give it a break for a little bit. It's, now what we're seeing, today, and over the lows are rising in contango, and contango's going. It's getting closer to contango. So we're seeing some of our clients back tests start to come into selling strategies, producing income on top of the more out of the money puts that they're looking at. So that when we're talking to clients, we urge them to utilize these triggers in their back test and set up environments and make sure that the back tests that they're using perform well in all the environments, especially the current environment, Mark.
Yeah, I've often said many times on our Volatility Views program that the answer to all of the market's questions, all the questions you may have in the marketplace, are lurking somewhere at the end of the day in that VIX futures term structure. It's only somewhat jokingly, because the truth is it's all in there. It's buried somewhere. It becomes a question of how do you decipher it? How do you translate it? For a lot of this year, the VIX futures curve has been somewhat decipherable. It's been very hard to translate what the heck's been going on out there when it's been so flat for so much of this year. That's the market effectively telling you, we don't know. We're throwing our hands up in the air and saying it's a coin flip as to what's happening out there, which is always a weird time, and that's certainly why I can understand why you would advocate a lot of your clients maybe take some of those income and more risky strategies off the board, because you don't really know what's happening for the foreseeable future. Now we're starting to see maybe a little bit of return of some of the normal shape out there. We'll see, of course, but that VIX futures term structure, as scary and as intimidating as a term like futures is, I know to a lot of you out there, at the end of the day, that is where a lot of the answers to the market's riddles are hidden. But Chris, you mentioned that volatility toolbox before. It's not just SPX straddles and VIX, listeners. There's a whole heck of a lot out there you could be using to trade and analyze and study volatility for your clients. If you're looking, maybe you're a little bit more inclined towards the SPY side of the fence rather than SPX, well, you got a new tool in your toolbox, a very new one. In fact, maybe you've heard it on some of our Volatility Views program, talking to the folks over there in Spike's land. That's effectively, you could term it, for lack of a better description, effectively a VIX, but on SPY rather than SPX. So if you're more comfortable, more knowledgeable of SPY than you are of SPX, which is a large institutional product at the end of the day, then maybe SPY might be, and spikes as a result, may be more intriguing to you. Of course, caveat there that it's a new product, so liquidity has still yet to build up out there. So maybe you want to dip your toes in there and walk before you run. But it's an interesting one to keep an eye on as the volatility space unfolds. And of course, I know a lot of you out there, and certainly your clients, we saw evidence of this last year with the VIXocalypse and how many people were damaged as a result of the issues with these volatility products. But it's the huge, the ever-expanding universe of volatility ETPs, these exchange-traded products. They could be ETFs, they could be ETNs. They come in all sorts of flavors, all sorts of shapes and sizes. But the big dogs in the space right now are kind of really the last of the Mohegans. A lot of the other big ones went the way of the dodo, unfortunately, are your VXX. That's a big one still. That's, of course, your big VIX proxy. A lot of people use it for, even though it's really not what it's meant for, and it's often quoted that way. And then we have SVXY, which used to be one of our old famous inverse ones, and then kind of went the way of the dodo after February of 2018, when a lot of these famous products like XIV, that was shut down completely, of course. SVXY became a pale shadow of its former self. It's effectively only half the leverage it used to have, so that's not as attractive for a lot of people out there. And still one of the old dogs of the space, TVIX, a product we love to malign here on the network. It's had many issues over the years, yet it's one of the last of the Mohegans out there, so people still trade it. And there's a lot of issues with all of these ETPs, as you might guess, listeners, not the least of which is an issue that comes from a lot of ETPs when they're trying to replicate another position using futures, and that is that roll yield, that negative roll yield, which impacts all of these. VXX is a great example. People come to the volatility space. Maybe your clients are coming to you asking, hey, how do I get exposure to this VIX thing out here right now? And an easy way a lot of people like to go is, of course, VXX, and they buy that and they put it in their portfolio. They set it and forget it, and that's effectively the worst thing you could be doing with this product, which, due to the negative roll yield, they are effectively, without getting too deep into the weeds, they effectively are buying expensive longer-term vol and then selling cheaper, nearer-term vol. Usually, as Matt mentioned, that contango with the VIX futures plays a part in that, so it's not always the case, but that's usually what's going on out there. And as a result, they are effectively churning and burning through a substantial amount of money on a weekly and indeed quarterly basis. I've seen estimates of that monthly impact of that negative roll yield could be up there, 10, 15% a month or more. So you have a product that's constantly eroding. Your buddy over there, Matt, Mr. Andrew, on our Option Block show and Volatility Views has called VXX predictably crappy. And that as long as you know what you're in for, it's okay. But the common use case, which is the set it and forget it, buy it and put it in your clients' portfolios, is not the way you should be approaching. It's a very, very short duration. All these products really should be short-term use cases, which maybe takes them out of the realm of use for a lot of you out there because you want a little bit more longer-term type approaches. But that's where we stand with a lot of those. And, of course, VXX also optionable as a result of that negative roll yield. Very popular strategy out there for a lot of our audiences, of course, that downside trade out there, the VXX puts and put spreads, just as long as you have something in your back pocket for when times like this past week happen and volatility has a sudden resurgence and VXX comes in a little bit. But there's a lot of different interesting ways to play them. Chris, let's go back to you again, sir, out there. I know you're mostly focused on the SPX and the kind of index spectrum, but I think a lot of the clients you guys engage with and a lot of the advisors certainly you guys engage with, they like this ETP space. They like their VXXs and unfortunately their TVIXs as well. What do you typically counsel people when they're looking at these products and maybe want to trade these things in their clients' portfolios?
Well, they have to understand if you're trading options on any type of volatility index, you're trading the volatility of volatility. And, there's two parts to a trade, right? There's the entry and the exit. And everyone spends a lot of time on the entry, doing their homework with respect to where the underlying may or may not go, where volatility may or may not go. You put your trade on, and then it's the exit, which is the difficult part, where people kind of put a little bit less time into, the monetization portion of the whole trade, right, from beginning to end. And what people come across on these kind of products is, especially if they're trading spreads, well, they don't see the expansion that you would normally see, like if you were trading a straight up equity market or index. So, people put butterflies on and they get it right, or the move happens too quickly they don't realize that expansion that they were, how come this fly didn't expand, or how come my call spread or my put spread didn't quite expand? So I would think these are like perfect products too. If you have a thesis or a theory, that I would certainly recommend doing a lot of back testing on these kind of things to make sure those spreads are acting like you think they should act. Because again, you're not trading an equity index product or a single stock. You're trading volatility of volatility.
Yes, a derivative of a derivative at the end of the day, which adds its own wrinkles and its own challenges to the analysis. Speaking of the analysis, Matt, you guys are out there doing a lot of analysis on this whole universe of products. So you got the new kid on the block, the spikes, which is SPY volatility. Then we've got this whole incredible universe of VIX ETPs out there. What do you say to your clients when they come to you looking for back tests and trading ideas on this expanding universe of additional volatility products?
Well, the good thing about the back test is you could see a lot of the things that Chris was talking about pretty starkly about these related VIX products just going, getting that roll. That roll is crushing. But, there are ways to play those. There's those call ratios, so you can make it so you're not losing that much money. And then if it really pops, you get those ratios kicking in. I've seen those used. Around the Twittersphere was a New Hampshire license plate that says VIX puts. And so I went and did a bunch of testing on VIX puts because, we're here in New Hampshire. You got to stay together.
I saw that. Is that your plate there, Matt?
Yeah, that's not my plate, but I've been following that guy around constantly. He keeps looking in the rearview mirror at me. I'm trying to figure out what he's doing. But I've done a bunch of back tests, and it looks like he's buying the VIX puts. And if you time it right, it looks like a pretty good strategy. So I've added that to my arsenal. That's what we're talking about, Mark.
Yeah, so just to recap here, listeners, we could obviously spend many hours talking about volatility and the strategies there, and we have done so in the past. I encourage you to check out our archives here of this program for some more deep dives into volatility. Wanted to kind of give you a bit of a refresher of how the universe stands right now coming into this time of the year when volatility sometimes gets on people's radar. So just to recap again, your straight, more direct volatility plays, so you're going out to your SPX, or even your SPY, your straddles, your verticals, those types of trades, your iron flies, your iron counters. Worth mentioning, by the way, of course, if you are a traditional advisor out there and you're hedging a long equity portfolio with some SPY puts or SPX puts, remember, you have a long volatility position on now. So you have that long S&P volatility, a.k.a. VIX position on. So just something to remember. You are trading vol, even if perhaps you're not aware of it. Of course, if you like maybe different indices, the spikes products are one to watch. But again, liquidity is a bit of an issue out there. Of course, the mothership is the VIX, and the VIX complex comes with many different products and also many different issues. First off, of course, remember you're quoting off the VIX futures, not the cash. The cash is a fun index to talk about and bandy about and chat about and to see displayed on places like CNBC and others, but it's not a tradable instrument. For that, you need to look at the futures curve. And as Matt mentioned earlier, the futures curve has a lot of mysteries locked therein. But if you can wrap your head around it, the contango, the backwardation, what's going on out there from week to week and day to day, that will certainly put you in good stead with managing those long equity portfolios. And, of course, the volatility ETPs, VXX, SVXY, TVIX. I think there should be a caveat emptor with all of these. You really need to know what you're getting into with all these products. They all have inherent issues. TVIX is a good example. It had many issues and almost shut down a few years back. Nothing to do with the market because of a crazy inflow of funds they had into that product. So these products are Franken products at the end of the day. They're constructed to try to replicate other things, and they do so with a mixed degree of success. So caveat emptor for all of those ETPs, and particularly with VXX and some others, just in general, short duration only. You don't want to put these in your clients' portfolios and set them and forget it. For options, VXX, the only one out there. Well, SVXY is optional. It used to be, but it's not really much of a need for those anymore. It's not really the product it used to be. VXX, obviously still a very popular options product as well. Just make sure you understand what's going on with the roll and everything else out there. Speaking of everything else, let's see what else you guys have on your mind. It is time for a second edition of our extended summer mailbag palooza. Yep, it's time for the office hours. All right, everybody, welcome to the office hours. You guys know the drill. You send in questions. We endeavor to answer them. We love all you guys. You're all hitting us up with all sorts of different questions. We do love to see the many different curveballs you throw at us. First off, we got a question here from Sergey. Sergey wants to say, he says, hello. Hello, Sergey. And he says, thoughts, please, on this article from Bloomberg on the options volatility. Thank you again. I'll go out on a limb and say maybe English, not Sergey's first language. But we got the drift. And this is an article everyone was asking us about on Volatility Views a few weeks ago. This was a piece out of Bloomberg, effectively quoting a Nomura analyst, talking about our old friend 50 Cent, a.k.a. a customer listener who comes in and buys a lot of upside calls in VIX, usually priced around 50 cents, a.k.a. that's why he got the moniker. And he says this guy has been buying so much volatility of late and so much upside that effectively, if you read the article, it says the bank's OTC desks and others have been scrambling to put on synthetics and everything else to hedge this extreme degree of upside exposure they now have as a result of this client's buying sprees. And we discussed this a bit on Vol Views a few weeks ago. We had a bit of mixed outlook on this because maybe this is happening in some of the VIX options, but some of the other products we see. Remember, we just talked about the volatility ecosystem. There's a whole ecosystem. There's ETPs, there's futures, there's the options, there's S&P, there's everything else. We're not seeing the other products really reflect that degree of risk yet that they're talking about in the article. But then it's an interesting setup for maybe potentially having a period of higher volatility. Let's go back around the horn again. Let's start at the director of risk again, because it's fun to say director of risk. Mr. Director of Risk, I'm curious, did you see the article that Sergey is referring to, and what do you think about this? You're a former market maker. What do you think of this 150 cent customer effectively buying up the street here, sir?
Yeah, I have not seen this article, but I have been following these trades. So I need to read it to make sure that, because everything I've read so far is that they haven't confirmed that it's 50 cent, only because this time around these trades seem to be monetized, whereas the last last time when 50 Cent was coming in, it was pretty much set and forget. And now, as they are getting these VIX pops, they're coming in and monetizing these trades. So if you do look at the VIX September expiration, the regular September expiration, there's a ton of open interest, on the 23, 24, and 25 strike calls. So yeah, there are some very large positions out there. And I think, it's not the trade itself. It's what happens after, it's what happens to the marketplace when these trades come in and they start to be monetized. Or let's say these trades do work out and the VIX does pop to 25 or 30. We've kind of already learned that there's this trickle down effect that is going to, or this rippling that's going to go through the financial markets and affect, broker dealers, market makers, banks that are on the other side of these trades. So I think that's really the trick nowadays. Kind of like what we saw, with XIV is like, okay, what is this kind of size of trade going to do to the rest of the markets when it does become an issue? If they fall out of the money worthless, okay, it's a non-event. But what happens if they do go and play? There's going to be a lot more forces out there with respect to volatility, which will lead to other types of hedging, futures hedging this way, that way, and that's when the volatility starts to come back in the marketplace.
I did have someone in the studio a few weeks ago who was talking off the record, and I often joke, I'm like the priest of the options market. Everyone comes into our studio and spills their secrets that I can't tell anyone. But so I won't say who this person was. But he was saying that he didn't think it was the same person who was the former 50 Cent, because as you alluded to, Chris, these trades are a little bit different now, and that person apparently who was at that firm is no longer at that firm. So apparently there was a bit of a difference of perception on the performance of those trades. So it can't be the same person unless he's at a different firm, but maybe someone emulating that strategy. And the name is catchy, so that's why they keep throwing it around out there. Matt, what do you think? Are you buying what Bloomberg and Nomura are selling here about 50 Cent, buying up all the upside on the street, sir?
Well, it certainly looks like the implied volatility of the VIX has gone up precipitously. Like, for example, the 20-day constant maturity has averaged since we started measuring about 93. Now it's up around the 120s. So my put buying is very expensive now, so I can't buy any puts right now, Mark. So I'm distraught. So there's something going on in the VIX, and they're cranking up the implied volatility. The back months are in the 80s, and the front months are in the 120s. So that certainly looks like a market maker is just jacking it up till they get some sellers, and that's what we used to do, Mark.
Yeah, so you're buying what Nomura and Bloomberg are selling. I mean, it's not the craziest thing. This guy someone is buying up a lot of upside, and you do have to scramble. I remember those days. I never traded VIX in the pit, but I traded SPX, and there were some times when we had those proverbial quote unquote upside crashes when the entire pit was short and someone had bought out a bunch of upside. And so as the S&P continued to rally and blow through strikes that everyone was short, yes, people were scrambling to cover, and you had effectively what was termed at the time an upside crash. Maybe we are setting up for a similar scenario. It certainly would explain why we have remained, as Matt alluded to, somewhat elevated out there in the volatility space of late, and continue to be, even though vol coming off a little bit today, but still certainly far more elevated. Usually this time of year, we're threatening single digits out there in the VIX cash, and we're nowhere near that right now out there. So interesting times out here in the market. Speaking of interesting time in the markets, I like this comment from Joey V. He says, this might be the best indicator of all time. And I do believe he's saying that tongue firmly in cheek. And he included a link to a graph someone put together here called, it's the CNBC Markets in Turmoil Bottom Indicator. And they have on this chart, and again, we haven't independently verified all of these data points are correct, but it certainly looks pretty funny. We'll include it in the show notes of effectively every time CNBC had one of their Markets in Turmoil specials, and what happened to the market immediately around that time frame. And it shows, as highlighted on this chart, every time they have a Markets in Turmoil special on their network, the markets, it's one of the better bottom indicators, at least looking at this chart. Looks like it works pretty good. Matt, you're more of a technical guy here than the rest of us. What do you think? Are you buying into this CNBC Markets in Turmoil indicator, sir?
What it used to be is when your shoe shine person starts talking about the market, that's the time to sell. I love these negative indicators. If it makes the cover of Time magazine, that's the time to sell. So I love this when the media catches on. That's usually the time to start buying or go opposite of what they're doing, Mark.
So CNBC, the equivalent of your cabbie asking you about SVXY. That's when you know it's time to get the heck out of Dodge. All right, let's go on to some more real. That's just a fun, silly one. We like the silly ones as well here. This comes from Alan. Next up, Alan Sidmond. He wants to know, what is a realistic number of SMAs, so separately managed accounts, listeners, on which I can expect to actively manage options positions using covered calls and short put spreads before I've spread myself too thin and can no longer devote my time to client development and management. And then we also have a related question, so we'll lump it in here. A similar question from 34DLD. He also wants to know, should I limit my options activity to the top 5 to 10% of my clients with larger equity portfolios and more sophistication to understand the strategies? Will that save me hassle in the long run? So different approaches to a similar question at the end of the day. How much of their time, resources, and client assets should they really be devoting to options, to all these strategies we're talking about here, the income, the hedging, all the other types of approaches we've outlined here on this show? Mr. Risk Director, sir, this is an interesting question for a lot of reasons, not the least of which that it's, we obviously come to it from preaching to the choir perspective a little bit, so we obviously advocate a lot of options usage, but for, the typical listener of this show where they're coming in and they're trying to say, how should I really utilize these? What do you typically counsel them? Someone who's coming to your 10th box event, something along those lines. How do you instruct them in these regards?
Well, this is a great question. Initially, my response is, well, it depends on technology. We have over 4,500 SMAs that we manage, and with option positions on each and every one of them. So it really depends on what kind of tools do you have at your disposal. I would say try to stay focused, because if you start getting too many accounts and you're actually managing all of them individually, you may have way too many types of strategies going on depending upon your clients. And I do think that understanding the strategies is key. You don't want to start throwing options on anybody that's not quite familiar with them, or is a little scared to get put their toe in the water. But again, the good news is there's a lot of material out there to educate people, to show them how you can use options in multiple different ways to achieve their goals. But as far as putting a hard number percentage-wise or number of accounts, that's really up to, that's up to each individual and their ability to manage that, and then what technology they may or may not have that can help them do that.
You're right. It very much is a technology question as much as it is a time question. Matt, you're kind of our resident tech guy here as well. We have to say here for our two listeners who are curious, how much of their time or resources or client portfolio should they really be devoting to these option strategies, sir?
Yeah, well, Chris stole the thunder there. It's a technology question. And one of the things that we do is spend a lot of time on the front end getting systematic strategies and helping advisors do that. And then we have ways to automatically scan and, alert for exits and send, emails out when certain things happen. So if you can, get the technology right, if you can, like Chris says, keep the strategies, somewhat generic or close to each other, and you could, send out client advice depending on how you're communicating to your clients. So a lot of what we do is to help support our clients communicate, help support our clients know when the exit rules were put on at the beginning, and so then it's a very systematic strategy, and then everyone understands what's going to happen, and then you could start to up that amount of clients that you can handle with options, Mark.
Yes, that's a good point. I think having similar strategies also helps as well. So first off, find a platform that allows you to scale and manage and implement. Don't use the old proverbial Excel spreadsheet. There are many platforms. That used to be, when we first started this show, that was a very common refrain. There aren't enough tools, there aren't enough platforms that allow me to really do this, let alone across all these SMAs, like you mentioned. It was a very laborious thing. You had to manage it yourself, track it in a spreadsheet. Now there are more tools available for you. I think a place to go to learn a lot about the different offerings there is, of course, optionseducation.org. They have a breakdown of all that stuff, and check out your platforms. And if you're bringing a decent amount of AUM to a particular custodian or platform, reach out to them and say, hey, I'm looking to do more of this, managing my covered calls, whatever it is you're using. You don't mention exactly what types of strategies you're using here, but I'm going to assume it's somewhere in that vein. And maybe they could help develop something with you as well that is more in tune to your needs. And also, if you don't have a custom approach for each client, but you actually maybe try to replicate something across a variety of portfolios, if you have a lot of your clients who are mostly in diversified indices, for example, and you like to replicate maybe a 2.5% or a 5% out of the money monthly covered call, that's something you could reasonably do and roll and manage across a variety of accounts with a handful of tools in a pretty seamless fashion. So technology is the first question. Find a platform, a custodian, a firm that will allow you to do this and make it and scale it. More importantly, than B, maybe devise a few approaches that you're comfortable using, that your clients are comfortable with you using, and that you can implement at a reasonable degree of scale across all of your different clients' portfolios. And then from there, there's no reason why you can't put this on all of your clients' assets. We obviously like options here. We talk about them day in, day out. We want you to hedge. We want you to protect. We want you to increase your returns. We want you to have, at the end of the day, a better client experience, better returns for everyone involved. And options can help you do that. So there's no reason why you should limit yourself to a handful of clients, unless, of course, you feel they're the only ones who would be suited for these strategies. And by all means, that's up to you. You know your clients better than we do. But at the end of the day, there's no reason from an overall asset perspective that you should limit yourself, unless you can't find the tools or just don't feel comfortable really applying it. So maybe you start small and then you grow from there as you grow with your comfort level. A lot of good questions in there. Great questions there. What were the names there? 34 DLD and Alan Sidman. All right, next up. Let's see. No beta wants to know. Thank you very much for producing such a fine program. Well, you're welcome there, Mr. No Beta or Nobita. I'm going to go with No Beta. I like that better. He goes on to write, I would like to know more about calendar spreads, in particular short calendars, where the customer sells the longer-term contract and buys the shorter-term contract. It seems like everyone talks about calendars from the other perspective. Why is that? Do you ever use the short calendar in your arsenal? Thanks again. Oh, and please thank Mark for creating this network. Well, you're welcome there, Mr. or Mrs. No Beta. We love to love at the end of the day. We love to spread the gospel of their options. Glad you're enjoying that out there. This is an interesting, I think we touched on this not too long ago. I'm trying to find the exact episode where we discussed this particular strategy. But you're right. Calendars typically, I'd say 90+% of the use case of the discussion of the education when it comes to calendars are on that typical long calendar side, which is buying the longer term contract and then selling the narrower term contract. And that's kind of the way it's structured for a variety of reasons, not the least of which being margin. I was talking about this with one of our friends, Mr. Overby, over there on the Options Playbook radio show the other day, this exact type of topic. And he mentioned, of course, if you do it the other way, then you have a lot of uncovered positions that are effectively going to be margined up the wazoo. So it's an expensive way to go the other way as well. So that's another reason why they're not talked about a lot. But in general, that is the approach. Let's go to Matt. I'm sure you had someone come to you in the past and ask you to parse this one for your back testers and see how it works. I'm trying to find the episode where we discussed it. I can't find it on top of my head, but I know we recently discussed this not too long ago on the show as well. What are your thoughts again on this? I guess you can call it reverse calendar, and maybe why it doesn't get the love that the traditional calendar does, sir.
Yeah, you mentioned a few things, Mark, but yeah, definitely you're going to want to find the option environment when the short call calendar is going to perform. I mean, you really need a pretty good pop in the stock and volatility to be low. I mean, unfortunately, like we talked about before, the rule of thumb where when volatility low, it stays low. You got to catch it at that point when volatility is low, but it's, you're starting to see some underlying volatility. So there are some triggers that we set to help identify those good times in the short call calendar. But like you mentioned, there are some pretty steep margin requirements for those, so it's not that popular with the retail crowd. We are seeing more reverse iron condors, however, and those don't have nearly the margin and have some similar, short or long volatility or long gamma characteristics. So I think that's why that the short calendars don't get the love. But they can definitely work well when if you have the timing right, and that depends on getting the triggers right, and they could really pop when if you get all those stars aligned in the right way, Mark.
Chris, same question for you, sir. Why doesn't the reverse calendar get the love, sir?
Yeah, it's a tough one because I think you're going to be along that front month option, so you're going to be sitting on that theta, and I just don't think that's attractive to a lot of people. And if you're short the calendar, you want some movement. You want some big movement away from that strikes, assuming that it's the same strike on the multiple months. So that's the challenge there. You got to have the timing, like Matt said. And I always kind of recommend people to look at flies and condors instead of calendars right when they're beginning, because then you can eliminate the term structure hassle. That's just one less input that you need to deal with, because calendars are kind of quasi-synthetic butterflies and condors. So you can kind of achieve the same thing without having to deal with two types of expirations. And then once you're comfortable with that, you can step it up to, trying to take or make predictions about term structure and all that kind of stuff.
All right, let's take it home with this one. Mr. Director of Risk, this is pretty much right up your wheelhouse. This one comes from, here we go, Nelson, just Nelson. Nelson wants to know, is it realistic to always have a long put against an equity portfolio, or is that just too much drag on returns? I've approached this with a few clients and had some embrace it and others push back against the cost. Well, Chris, when you're not talking to us here on the show, this is pretty much what you spend your days doing, is putting on those hedges and then finding ways to pay for them. So what do you have to say here for our friend Mr. Nelson, who's considering dipping his toes in those waters, but maybe is a little skittish about the cost?
Yeah, it can have a cost. I think it's dependent upon, are you using longer term options or shorter term options to hedge? Especially if you're in a program that is always on, at times it could be very expensive to buy that short-term hedge. So that's the caveat. Now, also there's a gamma issue, is how much protection do you want? What kind of move are you trying to protect? Is it a longer, prolonged bear market type of move, or is it just a short 5-7% type of correction? So, these are the issues that you have to define beforehand to try to pick the appropriate hedge. Okay, it always comes down to, well, what am I trying to do? What am I trying to achieve? And then, the second part is, okay, well, how do I pay for this or reduce the cost? And so a lot of people are already familiar with, tapping into that risk premia or being short volatility at good levels to help reduce that cost. So there's for every study out there that says, no, hedging doesn't work. Well, okay, for the last 10 years, we've been in a raging bull market that hasn't been characterized by huge sell-offs, and every sell-off has been recovered very quickly. So I could see that someone that doesn't remember the tech bubble or the great financial crisis, or has only been trading the last 5, 6, 7 years, probably says, well, why should I ever hedge? It just hasn't worked. But, when I hear more and more people saying I'm never buying another put again, that's probably means that something is around the corner or some event is around the corner where those puts will monetize. And again, it comes down to, am I hedging a short-term event, or am I hedging the big one that's going to really deteriorate, wealth in an account?
Yes, it's kind of the perennial question here. People want puts, but they don't want to pay for them. Hence the DRS and all the work you guys do there on a daily basis. Matt, I'm sure you've gotten this question once or twice here from various clients. What do you have to say to Mr. Nelson, who wants to know, is it really realistic to have that long put on all the time? And should he embrace it, or should he go with the clients who are pushing back against it?
Yeah, I think it's very responsible to have that put in there. You could buy some cheaper puts. We test strategies where you maintain a constant spread yield, we call it. So the premium that you're paying divided by the stock price. So when it gets volatile, when implied volatility goes up, you're buying closer in, farther out options, smaller deltas, and then when volatility is low, you could buy closer to a higher delta and go farther out. So those long put strategies tend to be more consistent on the cost, and then when you can monitor that cost, then you could do things like an income producing strategy, like it's buying one put, selling two farther out of the money puts for credit. So you're effectively putting on a butterfly if you have that long put. And then, like I said, we like to try to time that income producing strategy where when the contango starts looking a little dangerous, you take off the income producing. And so that's a way to pay for that put that you have on all the time. And you kind of surgically put on your income producing. So I love to have those. And incidentally, Mark, while we were talking, I ran a couple back tests on the short call calendar and the long call calendar, the short call doesn't. It's probably worse by about 80 basis points based on notional. And the worst times for that call calendar is when after a big move in the stock, and then the volatility gets elevated, and so you're buying that elevated volatility. And when that comes crashing down, those are the worst months that I'm looking at in the short call calendar. So, I think, again, surgically with the short call calendar, if you can get into it at certain points, time it a little bit better, look for some signs of life, but not have too much of that backwardation in there. I think that could be a strategy, especially if you're in a portfolio margining where the margining isn't as punitive as just regular margining. Mark,
that's why we like having you on the show, sir. You always come armed with the data and with the back tests. Unfortunately, that's all the time we have for data and back tests and for your questions on the program this week. But before we go, let's go back around the horn, check in with each of our cohorts here, see what they have cooking that may interest you. Our buddy Eric couldn't join us today from the OIC. He's busy fleeing hurricanes. It's something I'll be doing in a couple of days there as well, if not sooner. We shall see. But, of course, check them out over there, optionseducation.org. Click on the Advisor tab for all their great research and analysis and studies and everything else, so you can arm yourselves with the data that you can then turn around and share with your clients. So people like, who was it out here? We had Nelson and others and Alan and everyone else who was saying their clients, giving them some pushback. There you go. You can arm yourselves with some data. Let's go back around the horn. Matt, we're just talking about your data and your back tests and your earnings, move reports, and everything else. If our listeners are intrigued, they want to know more, maybe they want to kick the tires for themselves, maybe they want to talk to you directly about back tests, where should they go? What should they do?
Yeah, orats.com, and it's been quite manic here. We're just getting new things out there. Our guys have been doing a great job. Like we talked about, these component averages. Those are really exciting to look at. And we built a graphing tool to show those types of relationships, the contango, and then we've also built in like a mini back tester into a graphing tool. Like I like to point out, the best way to get people into options is to get them using the data, and the best way to get them using the data is to visualize it and start to do these mini back tests. So we have all kinds of things like that. Our data API, we're getting a lot more programmers coming to us. So it's been manic up here, and people have had a nice relaxing summer, and we've been going crazy up here, Mark. So, but a lot of fun.
Certainly seems like it with the breakneck pace of the products you guys have rolling out there. Check it out for yourselves, listeners. Orats.com, ORATS.com is the place to go. Give them a follow on Twitter as well. A lot of great nuggets and data and analysis coming out there as well at OptionRats on the old Twitter machine. And Mr. Chris, when you guys aren't busy dodging hurricanes, you're busy managing some overlays on some equity portfolios and also putting together some events and some content and some education for advisors out there. And if our listeners want to sink their teeth into more of that, sir, maybe check out one of your events or read your blog, maybe the newsletter. Where should they go? What should they do, sir?
Well, SwanGlobalInvestments.com to start off. We've got a new piece out by Mark Odo. It's called The Bleak Future of Bonds, and it talks about how bond risks threaten traditional portfolio construction. In addition to September 9th to the 11th, I will be in Munich, Germany at the SIBO Risk Management Conference, and I'll be presenting how 40 Act funds use options to achieve multiple goals. In addition to answering a lifelong question, why is Oktoberfest celebrated in September?
There you go. These are the great mysteries of life that need to be solved. I'm glad you are on the case for us, sir. So solve that mystery. And I've never actually been to the European RMCs. I've been to many of the domestic ones, never to the European one. So let us know how that is. You can see Chris in person if you're on the international contingent of our audience here and you're heading to RMC. You can meet the director of risk in person. Otherwise, SWAN Global Investments is the place to go. Give them a follow on the old Twitters as well. At SWAN Global is where you find them. And on behalf of Mr. Chris, a.k.a. the director of risk, and Matt, a.k.a. Mr. Oratz, and Mr. Cott, a.k.a. the guy who's afraid of hurricanes, and indeed myself, I want to thank all of you out there for downloading, streaming, subscribing, for sending in such great questions. We could do a whole show of just those. You have so many great questions. Keep them coming, and we'll see you next time for more of The Advisor's Option.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.